Hello everyone, I hope you're all well. It's Susie here from Esoteric Trading Solutions. Please be kind to yourself, be kind to your family and friends, be kind to your animals, and please be kind to just anyone that comes into your life to make this world a better place. What I'd like to talk about today is the futures market and the cryptocurrency markets. It is important because as the professional traders and the professional investors get into this market, they will be the activity in terms of futures will be increasing, and it will have more and more effect on the physical cryptocurrency markets, that most people trade at the retail level. So it is fairly important. So when we talk about futures, and just before I say that, excuse me, this is educational only. I'm not looking at your financial position, your risk tolerance. I'm not an investment advisor. I don't give investment advice. And basically I don't know your age and all that sort of stuff as well. So when we talk about futures, what are we talking about when we talk about futures? Future contracts pretty much are basically you can buy or sell a specific financial instrument, and there's futures for a lot of different financial type assets. It can be for treasury bills, it can be for bank securities, it can be for bank bills, certificates of deposit, foreign exchange, for example, government bonds, it can be equities, it can be futures over the S&P, over the Dow, and of course Bitcoin. In the Australian market, we have bank bill futures, we have cash futures, we have bond futures, and all sorts of things. But also, there's a lot of different types of futures contracts. Most of them are obviously issued by the exchange, regulated exchanges, and they are standardized products which have a maturity date, and you buy at a spot rate with a maturity date in the future. And most of them will basically be cash settled or physical delivery. So for example, if you bought, say for example, you bought a wheat future or a wool future, or say a cattle future, or something like that, or a coffee future, and you didn't close it out before maturity date, there would be physical delivery. In other words, you would be buying wheat physically with cash, and you'd be buying, wool or whatever it might be. Other futures have cash delivery. So for example, in the Australian market, we have bond futures, which are basically cash settled, but if you have bank bill futures, BAB futures, there will be physical delivery. So say for example, you don't close out the bank bill futures, and say you bought bank bill futures, there will be physical delivery. So in other words, you'll be expected to buy physical bank bills, and you will have to come up with the cash to buy those physical bank bills. In the regulated market, and the professionals trade futures as speculators, trading on the price going up and down and trying to make money. So obviously if you buy futures and the price goes up before the maturity date, you make money. If you sell futures and the price goes down, you make money that way as well. You can also do what professional investors will do is they'll manage futures against an investment fund or a fund management fund or whatever, and they'll basically try to lock in profits with futures, or they'll try and hedge their portfolio against losses. Now that'll be, I will do another presentation for that, but it won't be for YouTube, it'll be for my clients within my subscription business. So what we've seen at the moment is Bitcoin futures are available, and they're available on the following exchanges. The regulated professional exchanges, which are regulated by the SEC, Security Exchange Commission. Regulation is very, very high. It's very, very compliant. There's a lot of compliance, and everyone needs to obviously cross the T's and fill out the right forms and everything else. So it's on the CME, the Chicago Mercantile Exchange, and the Chicago Board of Exchange. The NASDAQ will eventually bring in futures. They're talking about the third quarter of this year, 2018, and essentially they're talking about Bitcoin futures. Now there is some discussion at the moment about Ethereum, sorry if I pronounced that incorrectly, being put on the futures market as well, possibly for the CME or CBOE. You just have to keep an eye out for that. And once that happens, you'll basically find that the physical underlying assets that you trade on the cryptocurrency markets, the physical trading of those assets will change quite dramatically, because it means the professional investors can come in from the futures market to the physical market and vice versa. Okay, so futures are market to market every day. So in other words, if you hold a future position and say, for example, you buy Bitcoin at 77,600 US, and at the end of the day, that contract is worth 8,200, you've made money. On your future statement, it'll reflect that you've actually made profit on the day. Now, if you don't close that out, that will be subject to market tomorrow. And if suddenly the price has gone down, Bitcoin, say for example it's gone down to 7,100, you've actually lost your profit from the day before, and you're then in a loss situation from 7,600 to 7,100. Sorry if I'm speaking very quickly, but there is a lot to get through on this presentation. In times of volatility, you'll find that futures will be marked to market twice or three times a day in times of massive volatility. So in 2008 and 2009, when the equity market was going down, the exchanges marked to market quite regularly throughout the day. And they would basically look for clients that were in massive loss positions to top up their deposit margin. Now, if they didn't top up their deposit margin, say for example the margin was eroded because of the moves against their positions, they would be basically closed out. So essentially it was really important if someone was long the futures market, in other words bought futures, say on the equity futures, and the market was going down, and if they were taking losses and that was eroding their deposit margin. With all futures there will be a deposit margin which is set by the exchange. That deposit margin would have been eroded with losses. Also, in times of volatility on the professional exchanges which are regulated, those deposit margins will go up. They'll increase because of such volatility in terms of the price action of the futures market. Okay, if everyone's selling, you'll find equity futures, the deposit margins would have been increased to buffer the losses, but also the exchanges would have done intraday mark to market to make sure that people keep topping up their loss positions. Now, if they don't, they'll actually close them out. Okay, so let's just go to the next slide. So as I said before, futures can be cash settled or physically settled, and it depends on what futures contract you're talking about. You need to know what futures contract you're dealing with. And as I said, bond futures in Australia are cash settled, and bank bill futures are basically settled out with a physical security. Bitcoin futures are cash settled on the day of maturity. Okay, just close that down. So if we go to the next one here, if we go to the exchanges, I will come back to the exchange of physical, which is also very important. If we go to the exchanges, the Chicago Mercantile Exchange has Bitcoin futures, and this is them here, and you'll find they have specific maturity dates. They'll have last price, basically the change, price, settlement, open, high, low, and close. It'll have the volume, high, low, and basically it'll have maturity date. So if you look into each of these contracts, you'll find the maturity date. So if you don't close these out before the maturity date, on settlement there'll be a cash settlement. Okay, and that cash settlement will basically be settled off a cash settlement reference rate called the Bitcoin reference rate. No different to, say, bank bill futures, which is settled off a bank bill futures reference rate. The way they settle it within the Bitcoin futures market is they'll use 12 spot rates in the last hour of trading. So they'll close that settlement rate at 4 o'clock, but it'll be 12 spot rates within the last hour of 5-minute windows. Okay, so there'll be 5-minute windows, 5 minutes, and there'll be 12 windows within a 60-minute period, and at 4 o'clock that Bitcoin reference rate is settled, and that determines your profit and loss on your Bitcoin futures. Okay, and so basically, and people can they know whether they're making money or whether they're not. Now, in terms of Bitcoin futures, you can basically cash settle your futures on maturity, or you can roll them out to another maturity date. So say, for example, I was long January Bitcoin futures and I was long 50 contracts, and I wanted to keep being long Bitcoin futures 50, and I believe the market was going to go higher. I want to keep my position, so I'd do a calendar spread. Basically, I'd sell my January 50 on maturity date or before maturity date, and I'd roll forward to the next contract settlement date, say March, for example, and then I'd still be 50 long. So all I'm doing is selling my January and then buying my March for the same position. Okay, now in terms of this business BBR calculation, it's basically calculated by the equal weighted average of the volume weighted medians of the 12 petitions or windows in the last 60 minutes on the spot market. Okay, now the regulators will look at this very, very carefully. In other markets, there has been fraud and unscrupulous practice where, say, for example, LIBOR, which is the London Interbank Offer Rate, was set, too high or too low, and where traders on their revals either made more money or less money. Obviously more money because their bonuses were on that. And so therefore, say, for example, if they'd done swap positions or derivative positions, they actually made more money and their bonuses were on that. So there's been a lot of, a lot of fraud in the past, and some of these traders went to jail. It's happened with BBSW, the bank bill swap reference rate as well, but it's also happened with LIBOR rates and all other reference rates, say to bank bills, say to swap rates and derivatives and that sort of thing. So if we go to the next slide, CME, Chicago Mercantile Exchange, has Bitcoin futures, and they have the specifics of that. So, one Bitcoin future will be 5 Bitcoin. So that's the position. They'll have particular times for trading hours. They'll have the tick value on these futures. So, per Bitcoin $5, the 5 positions is $25 a tick. And basically, it'll give you, the clearinghouse and the product and that sort of thing. Again, the monthly contracts listed are the nearest 2 months in the March quarterly cycle, so March, June, September, and December. And then you'll have a 2 serial months, which is the next months as well. And financially settled is basically cash settled. So trading terminates at 4 p.m. London time, as I said, and that's when obviously 4 o'clock every day rates will be set. Okay, so and again, as I was saying, we're talking about margins. Like I said before, initially, margins on these maintenance margins for these maturities will be here, as you can see. So obviously, the further out you go, you'd expect those margins to be higher. Also, the maintenance volume is 90%, but the margins are quite high. They're over 16,000. Now, as the markets get more and more volatile, the exchanges, the regulated exchanges, the professional exchanges will ask for more margin. Okay, and as I said before, they'll do intraday mark to market. So we've got different settlement dates, for July, 1st of August, August, 6th of September, September, 3rd of October, October 31st, and the 3rd. And, we've got just tick value and that sort of thing. In terms of CME, volume has increased by 93% from last year, as you can see. Now, I suspect as time goes on, these volumes will get bigger and bigger, and they will certainly affect the physical market. Okay, and we'll come back to that, how they interact between the physical cryptocurrency market that you and me play on. So also on the Chicago Board of Exchange, they also have Bitcoin futures, and that's their specifications, and you can look that up on their website. I won't go into that too much. And again, you can look that up. And it gives a bit of a blur about it. And there's their future strip. It's called a future strip. So you've got the expiration dates, 15th of August, 19th, 17th, whatever. Now, what professional investors or traders will do also is a arbitrage between the Chicago Board of Exchange futures contracts here and the CME's futures contracts with Bitcoin futures as well. If there's an arbitrage, they will take that money and run, basically. So say, for example, they had the same maturity dates, and one's trading, say, for example, just put it out there, say 8,500 on this exchange, and on the CME it's trading at 8,000. What they'll do is they'll sell at 8,500 and buy on the other exchange, and keep doing that until that arbitrage is gone. At the moment, there's only Bitcoin futures on the regulated exchanges, but if you look at Crypto Facilities London-based, which is not a regulated exchange at the moment, they basically have Bitcoin, they basically have Ethereum, as you can see, they have Litecoin, and they have Ripple. And obviously, Ethereum's coming, fairly soon, okay? But obviously the SEC has to clarify, whether it's a security or whether it's not. Now, the role of futures, as I said, can be for speculators who buy and sell to speculate, to make money between one price and another, or you can buy and sell futures to hedge your underlying investment portfolio or your fund. Okay, and that's really important to protect your gains or lock in gains. Now, what I want to go back to is the link between the physical market and the futures market. And this link will get stronger and stronger as time goes by. On the professional market, professionals can do exchange for physical. And professionals know this as EFP. Okay, so what it means is, if we want to do an EFP, say for example, I'm a professional fund manager and I've got I'm long a whole heap of Bitcoin futures, but I don't want to keep rolling those futures over. I don't want to keep rolling them over every month. I want to get access to the physical market, the physical cryptocurrency market. So what I will do through the exchange and through a broker is I will basically sell my future position and buy the underlying physical for the same equivalent position that I had in my futures market, very simply. And that will be done through the exchange, and the paperwork and the documentation has to be done within an hour. It used to be an hour, and they're very strict on this, and I'll do it with a broker. So what will happen is I sell down my long position in my futures. Say I've got 100 futures in January or March. I sell down my long position in my futures position, and I go and buy the equivalent Bitcoin in the cryptocurrency market, done through the exchange and through a broker. Okay, now the difference is between futures and the physical Bitcoin, as you know, is you need cash to buy the physical Bitcoin. With futures, you only need a small deposit margin to get exposure to the price of Bitcoin. That's why they're futures. They're highly leveraged. You don't need a lot of cash to get the same exposure to the physical market, okay? And that's really important. So for me as a professional investor, I'm running a fund. I have a whole heap of Bitcoin futures, and I want to sell those down and swap into the physical Bitcoin coin, okay? And then house it in safe custody so there's no malicious attacks on it, in cold custody. And so I will do an EFP transaction, exchange for physical, and I'll do it with a broker who's a registered futures commission merchant and who can offer me institutional grade cryptocurrency exchange. Now, what's important about this is the professionals can come into the Bitcoin market, the cryptocurrency market, and buy physical Bitcoin from their futures positions. Okay, so what you need to know too, with future positions in the exchange, you know, many contracts can be issued constantly. No, there's no limit on that, no limit whatsoever. But in the physical market, there's only so much coin. Just like in say the wool market, there's only so much physical wool, but you can buy and sell to your delight as many wool futures as you want, right? And also you get leverage, so you can buy and sell even more than the physical cash that you have to buy wool futures. And the same applies to Bitcoin. In the Bitcoin physical market, which is the market that you and me trade, or the institutional guys trade, or girls, the institutional grade cryptocurrency exchange, Bitcoin will only have so many coins out there. So in terms of that, you run the risk with any asset or any digital asset that's on the registered, licensed futures markets. You run the risk that more futures have been issued than the physical digital asset. You see what I'm saying? So that means basically when that happens, you could get an absolute run on the physical market, a run up, because there's a shortage of digital coins, okay, where digital coins could literally run out. Now, I did see that with one issue where digital coins did run out. Now, if that was the case, you're going to get an absolute bull run, okay? So pretty much anything that has futures on it will go for a run when there's been so much issued from the exchange, and most investors, professional investors, are buying at the low end when Bitcoin was down at, say, 5,600 or something. And the same would go for Ethereum, the same would go for XRP or Litecoin or any of the other top 4 or top 5 if futures were issued on those digital assets, those physical digital assets. Now, futures themselves are basically the derivation of the physical asset. They look like Bitcoin real digital assets, but they're not quite, and they're supposed to give you the same exposure as the digital asset. But as you can appreciate, there is basis risk. And what I mean by that is the futures will trade different to the physical asset, because the physical asset, the digital asset, can be made short in the market. In other words, it has only a certain amount of quantity, a certain amount, and that is it, where the futures market can keep issuing more and more futures. I hope that makes sense. So as the market gets more investors, professional investors into the market, the nature of the underlying physical assets will change. And I suspect as the market goes on and there's more futures contracts put on to the professional exchanges, you will see the physical crypto market change quite dramatically in terms of how it trades. And you guys, the retail people, myself included, we need to be totally aware of the volumes being done on the regulated professional exchanges, particularly in terms of futures. Okay, there's a link here that you can look at in terms of this story here, this one here, and you'll see with Wall Street in the last 2 weeks, Bitcoin is up about 35%, and apparently Wall Street was behind that, where they did their first EFP, exchanging out of futures into the physical asset. Okay, they had all these futures on their book. They had a lot of cash. They wanted to get rid of their futures position and put it into the physical asset. Okay, rather than this mark-to-market approach. Really, really important. So you'll find that this will change the way the cryptocurrency physical market trades forever. And the more institutional people get into this market, the more this market is likely to go up. And that's why I've said to you in the past, with wholesale investors, they can push this market dramatically up, pretty much. That's my view. That's my personal view. Please don't take that as being trading advice or financial advice or anything else. But, we're talking huge amounts of volume. Now, for example, BlackRock is going to come into this market potentially. The guys manage $6.2 trillion worth of funds. Even if they invested 1% in the cryptocurrency market, the physical market, that is $62 billion, right? At 1% of their overall portfolio, $62 billion. Cryptocurrency market, physical market is currently $301 billion. So massive, 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 massive. Anyway, guys, I am going to be doing another presentation on this, how to use futures in terms of your investment portfolio, but I'll be doing that for my subscribers. I hope you get something out of this. My subscribers, my paying subscribers, and I've got the obligatory, just going through all this stuff, I've got the obligatory disclaimer. This is not meant to be specific advice or general advice. It's only educational only. I hope you get something out of it. Please all look after yourself. Again, be kind to yourself, be kind to your family and friends, be kind to your animals, be kind to just anyone you come across. Please make this world a happier place and a nicer place. Thank you very much. Susie.